First, thank you, Jim. Now, I recognize the situation, even though I haven't talked for a while. All the students clumped in the back of the room. You know, to get as far away from the speaker as possible. I'm not sure why, but it happens every time, every classroom I've ever been in. It's really not much further to walk to get to the front of the room, and you can hear the speaker better. Anyway, thank you, Jim. And thank you all for having me out here. I was walking around this afternoon, and my wife has a New Year's resolution she does every year, where she wants to see one new museum a month. She's a historian. She's, by the way, the co-editor of the California book. And I discovered the Pizza Hut Museum. So I took a picture of it. I couldn't go in, it was closed. Took a picture of it, sent it to her. I said, "Aren't you jealous?" And she said, "Can I count it by proxy?" I said, "No, it wasn't open." And then I went back, and can you guess how many countries Pizza Hut operates in? 110 countries, 110 countries. So first I thought this is sort of this local thing, and I discovered it was founded in Wichita. But maybe they care about the international financial system also, possibly. Okay, so Jim called me many months ago and said, "Can you come talk about the international financial system?" I said, "What do you mean?" It was a little vague. So members of his board wrote down a few thoughts, sent them to me. But I figured, I can sort of define it more or less the way I want to, because it's a pretty broad scope. And you can see from the idea of doing trade, dollar, financial crises, and Trump, which is going to be the last part, you have to stay around for the good part, that it's a pretty broad canvas, but we're going to only sketch parts of it. This is a sequence in which I'm going to do it. First, I'm going to talk about how it came to be that we lived in what we now could call international financial system, or you may sometimes refer to as globalization, and the role of the dollar in that. So the first thing is going to be a story. Then the next part is going to be sort of what are the pieces of it, both internationally and domestically. And then, very briefly, just to remind you of the great financial crisis, because I think that is an inflection point in the system in which we live. And there's an appendix here, which we won't talk about, but Jim can give you the PowerPoints. You can look at the appendix on your own. So let's start here. How many of you have traveled internationally? So you get out, so you already know the answer to this already. You get off at an airport in a country and all you have is dollars. Their currency is not dollars. What do you do? What? You go, almost any kiosk will take your dollars, right? Almost any kiosk. Now, if you had Norwegian krona, Brazilian reals, Mexican pesos, probably not so lucky. Why is that? Why are they all wanting to take your dollars? Any thoughts? No, we'll talk.
It's supposed to be the currency of...
Currency of the world currency, you're right, yeah. But what is the dollar? So let's talk about that, because the dollar, like all currencies, really has three functions. This, by the way, is why crypto is not a currency when you listen to these functions. First, the dollar is a store of value. From whatever you have in your bank account to the $7 trillion in assets sitting in the Federal Reserve, the $6.5 trillion sitting in the People's Bank of China. They're not saying the stacks of dollar bills, by the way. Instead of treasuries and other things like that. So it's a store of value. And stable value. You don't want something that is worth $7 trillion today, $3 trillion tomorrow, and $10 trillion the day after. It's a store of value, stable. Whether that stays that way may have a lot to do with this guy, this orange mop in Washington. Yeah. Secondly, it's a unit of account. How much is my house worth? How much am I worth? What is the value of this thing I was about to buy? We measure it in dollars. The interesting thing is, around the world, things are often measured in dollars, even in countries where the dollar may not be the currency. So it's a unit of account. And finally, it's a medium of exchange. From buying eggs at the grocery store, which I think are now like $6.50 a dozen. This guy promised one time to bring them down. It really hasn't happened yet. To buying oil from Saudi Arabia. It's almost always invoiced in dollars. In fact, about $190 trillion worth of transactions flowed around the globe last year. Now, all currencies have these three functions, but the dollar has, as Jennifer said a minute ago, these three functions globally, almost everywhere in the globe. But, the dollar actually changed, and most of us in the room lived through this change. On August 15th, 1971, then President Nixon said, the dollar is no longer convertible into gold. That was an incredible inflection point to birth the international financial system we know today. Because up till then, from Bretton Woods in 1944, when the victors mostly in the World War II got together and set up a trading system, The dollar had been tied to gold at $35 an ounce. And other currencies had been tied to the dollar. So the other currencies were indirectly tied to gold. And for a while it was the case you could go and get gold. Then that stopped up. Then only central banks could go and get gold. And finally we stopped that. But on that date, by the way, I had a friend who was in Switzerland. He told me later, the next 2 days, the Swiss banks would not take his dollars. So they didn't know what they were worth. Nixon had blown up the whole system. He probably didn't understand what he was doing, maybe like the current president. He'd blown up the whole system. And the banks sort of figured it out after a while, Sam said, but the first couple of days, they would not take his dollars because they just didn't know what the dollar was worth anymore. And that also meant, because that meant these relationships between these other currencies and the dollar and each other were all of a sudden unknown. It's like you have this algebraic equation with 10 problems and 12 unknowns. How do you solve it? Well, the dollar became, at that day, fiat money. Fiat money, it means it's money because the state says it's money. The government says it's money. How do you know that? You can pay your taxes in it. You can pay your taxes. That makes it fiat money. All currencies enrolled in there are fiat money, all currencies of any size, the fiat money. There's nothing behind them. They're not cowrie shells behind them. There's not gold behind them. There's not whatever behind them. It's this money because we're told it's money, and we acted as money, and it's accepted as money, and you can go from place to place with it as money. And I know there are some Republicans in Congress who don't understand this after all this time, but that's their problem. So why did Nixon do this? And there were several things that were going on. First, he did it in 1971. So we'd come through a period in which we're running some fiscal deficits, small compared to today, but nonetheless worrisome at the time. There was a bout of inflation, not a particularly high bout, but it was a bout of inflation. The US deficit was rising. And remember, deficits are annual things. Debt is what's accumulated over time. Deficit was rising. And another small minor point, there wasn't enough gold. If everybody who had dollars came and asked for gold, there would not have been enough gold to go around. There just wasn't that much gold, which is an interesting thing to think about when people say, let's go to the gold system. That means you limit the amount of currency you can have. You can only tie how much gold there is. And then West Germany, interestingly enough, had decided to leave the peg. They decided to let the Deutsche Mark float against the dollar. That is to see what people thought it was worth against the dollar, not the fixed exchange rate. They did that in a few months before Nixon acted. And they discovered the Deutsche Mark was worth more than it was valued against the dollar. Switzerland did a similar thing. And then, of course, there's a famous story of France sending a ship over saying they're going to demand for our gold. And Nixon said, well, you can't get it because it's not there anymore. It's irrelevant. So with that, he actually created the international financial system. Now, I'm not saying he sat there and had an economics textbook and figured out what he's doing. He didn't. But he did create it. And at the time, people thought it was a sign of weakness. The dollar was in trouble, the US economy was in trouble, and it violated this assumption that came out of Bretton Woods that trade and economic growth was very much dependent on fixed relations between different currencies. Now, they drew that lesson from the 1930s, and may have been true in the 1930s, and it seemed to work for at least a quarter century after Bretton Woods, but it violated that assumption, totally violated it. But it turned out to be a very successful move, amazing enough. In 1970, the value of global trade was about 22% of the global gross domestic product. That's the value of everything produced in the entire world. Global trade was about 22% of that. Today, it's about 60%, a tripling in that period of time. And it generated a huge amount of cross-border financial transactions. It also made the dollar, interesting enough, even more important in some important ways. So today, think of the dollar as a store of value. About almost 60%, 58%. You can go on the IMF website under COFR and it looks up. About 58% of all central bank reserves in the entire world are held in dollars. Again, they're not stacks of $100 bills, the treasuries and things of that nature. No, 58%. We're an economy that's only 25% of the global. About 64% of debt globally is dollar denominated. Even if it may be issued by Argentina, Thailand, Norway, much of it is dollar denominated. And trade is predominantly conducted in dollars. Around the globe, about almost 60% is conducted in dollars. But if you take away the euro area, 80% of the rest of the trade is conducted in dollars. And if we hadn't sanctioned Russia, probably even a higher percent would be conducted in dollars. In the euro area, and it's interesting, there is this other very important block out there, which is trade is almost always conducted in euros for obvious reasons. They're on a single currency. It's like trading between Kansas and Nebraska. You don't try to figure out the currency, you're both on dollars, right? That's not a problem. And then as a unit of account, well, how big is the global economy? Well, it turns out it's about 127 trillion, big. How big is the US economy? Oh, it's about 25, 27 trillion. China, about 18 trillion. So we use this as a major trade and a unit of account, the dollar. And that's really what it is. And this is what happened. I said the trade grew. So we start at the beginning here. You see down there in 1970, when the gold peg was removed, as I said, about 22% of the value of the global output of everything we do was traded. And then there was what's called the gold peg was removed. There was another currency meeting called the Plaza Accords, which I may touch on later, but it's just a marker. And then this thing called North American Free Trade Association was created. And then the euro was created, and it's keep up and up and up. And China joined the World Trade Organization. And then you see an interesting dip, which we'll come back to. Well, you see this really long rise of global trade over a long period of time, something that has only one parallel in history, which we'll go back to a little bit later. So today, global trade is about $65 to $70 trillion, mostly in goods, but some in services. So this was this creation of this new system, which there was a lot of skepticism initially. I said, my friends said the bank wouldn't take his dollars in Switzerland. They didn't know what they were worth, but it turned out to be fantastically successful. And of course, when you think of trade, this is a picture of San Pedro Bay, where Los Angeles Harbor and Long Beach Harbor are. Those are, of course, containers. 40% of everything we consume in this country, of goods we consume in this country, comes through those two harbors. I wrote a piece that's in one of those magazines called Getting Stuff from Here to There. It means it comes into the harbor. It doesn't just sit there. Los Angeles is a very crowded place. It's loaded onto mostly trucks, some railroad, and shipped inland to what we call the Inland Empire in California, San Bernardino County and Riverside County. And there it goes to a lot of warehouses, including a lot of very, very, very big Amazon warehouses. How big some of those warehouses Amazon are? Over 1 million square feet. And most of them don't have windows. I've been out there. It gets hot in the Inland Empire, very hot. There are ongoing efforts to try to organize the workers there, most of whom are Latino, and some of whom, of course, are undocumented. And one of the issues is heat and control of heat. So they've been pressured, and to some extent, Amazon has created these cooling rooms. But last August, some workers took thermometers into the cooling rooms. The temperature is over 90 degrees. This is the cooling room. And if you're unloading one of the planes, they do fly some stuff in there by plane. You're inside this metal body when an outside temperature during the summer in the Empire is over 110 degrees very frequently. It's really hard work. And by the way, that's one of the reasons it's hard to organize. The turnover rate at Amazon warehouse is 150% per year. The average Amazon worker stays there 8 months, and that's it. It is really grueling work. If you're more intellectually interested, this is a picture of what a book that is really worth looking at is called The Box. It's simply The Box. It's a very interesting book on how we came to this container world. And it starts back in the late 1950s in the sort of creation of this thing we now call the box. And if you have, some of you are students, you have extra time, and you're not in class all day, go read this book. I think you'll enjoy it. Okay, so let's just summarize this first part. We're talking, this is a history story. The dollar as global currency, accepted everywhere for almost anything, and the functions of the dollar as all other currencies have, the three of them, store of value, unit of account, means of exchange. The apparently overthrow of the dollar in 1971 that turned out not to be the overthrow of the dollar, and the global trade grew. Okay. So what I'm doing now is sort of talk about the pieces of the international financial system and the US financial system. So the components, and there's some of these that we can't talk about. I think are important ones. So let's talk about the international financial system. So when your board got back to me, people said, well, banks are part of it. That's true. Banks are a very important part of the international financial system. There's different kinds of banks. There's the kind of bank on the corner, which may be just a commercial bank that you put your money in. There are investment banks, JP Morgan Chase, Jamie Dimon, all those people who do things on Wall Street and other stuff that maybe we don't know about. There are central banks. Most of the time, we pay no attention to central banks, but every so often, like during the Great Financial Crisis and during the April Trump crash, we think, oh, what's the central bank going to do? And Trump, of course, is obsessed with what the central bank is going to do, the Fed in this case. Okay. And then there are non-bank financial institutions, hedge funds, private equity funds, trading funds. And there's this proliferation of things like that, and we'll talk about how that came to be. But they are very important. But it's not these institutions alone, it's financial markets. And as Jim said, I worked for a long time in financial markets. Now, the interesting thing about financial markets is they're a little bit different than, say, the farmer's market. You go to the farmer's market, you give them money, they give you, well, out where I live, they give you lemons or oranges, or because we have lemons and orange trees in our yard, but they give you stuff back. Or you go to a clothing store, they give you a shirt back or a dress back or whatever. Here, you're trading claims on stuff. You're not actually trading the company, for example. You're trading a claim on the company. So one kind of financial market are equity markets, New York Stock Exchange, Hong Kong Stock Exchange, Shanghai Stock Exchange, London Stock Exchange. You're trading stuff that are claims on those companies' assets. And that gets actually more attention than it probably deserves compared to the next kind of market, the debt markets. Because debt markets are where you'll actually have a better claim on the asset. If you're looking at a company that's going bankrupt, have the bond and not the stock. Because in the bonds, you're at the top of the queue. The stock, you're at the end. If there's anything left over, then you might get it. You're a bondholder, you will have first call on it. And these debt markets are huge. The U.S. Treasury debt market, which is the biggest one in the world, and the one that has really wobbled in early April, is about $27 to $30 trillion in size. And there, of course, there's markets for the UK gilts, there's markets for the Bund, the German, and so forth and so forth. Overall, if you look at the debt markets, they're huge. We'll talk about how big they are in a minute. But the third kind of market that I'm going to guess many of you are somewhat less familiar with are derivative markets. Now, this is not a course in derivative markets. I have taught that, but I'm not going to do that today. But the thing to keep in mind is that derivative is derivative because its price is ultimately determined by the price of something else. So there's a thing called the S&P 500 futures, traded on the Chicago Mercantile Exchange. Its price is ultimately determined by the prices of 500 stocks that are in that index. The ones that are probably most important for the international financial system, though, are two different derivative markets. One's on currencies, that is, futures and options on things like the mark, the pound, the yen, when they still existed, or now on the euro, the yen, the dollar even, and interest rate derivatives. Now, notice that both of these started very shortly after Nixon. They started in the early 70s. So Nixon's breakup of that fixed exchange rate reconfigured this international financial system and recreated it in a new and different way. There is another kind of component of the international financial system. There are these regulatory agencies out there that do a good or bad job. We're not going to pass judgment on that today. They're out there. The Securities and Exchange Commission, the Finance Authority in the UK, Chinese Regulatory Commission, they do things like that. And then there are these interesting things out there that we mostly are a little bit less aware of, what I call global non-governmental organizations, NGOs. And the two that you probably have heard most about, the International Monetary Fund, IMF, and the World Bank, were both founded in 1944, back at the time of Bretton Woods. The one that is actually in many respects more important to our system today was founded in 1973. It's called the Society for Worldwide Interbank Telecommunications. Financial Telecommunications, SWIFT in short. Again, 1973, very shortly after Nixon reconfigured that global system. What's the medium that connects all these things together? The institutions, the markets, these institutions, it's the dollar. The dollar is I don't know how to describe it. If you want to find this gauze or the spider web that ties everything down, it's the movement of the dollar back and forth and around. And of course, what it means is there are markets in money. So think about it this way. Before Nixon's action, if you were buying, let's say, German transmissions to build a car in the US, you knew, let's say there were 4 marks to a dollar, which is roughly what it was. You knew there were 4 marks to a dollar, you know what the exchange rate was. Now you don't. So you're taking not only the risk of it, is it going to be the right transmission? Can I get enough of them? Will it work correctly? Also, how much will I gain or lose if the relationship between the dollar and the mark, or the yen and the peso, if that moves around the course of this trade? I have a new kind of risk in international trade. And of course, the answer to deal with that new kind of risk were these futures and options markets. Because up until that time, and I started working, by the way, in futures markets in the year my daughter was born, 1982. Up until about that time, or a few years before that time, mostly futures markets were the backwater of finance. They traded things like soybeans, wheat, gold, platinum, live pigs, live hogs, cattle. I walked through cattle stockyards as part of my work at that time. But most people didn't really worry about that very much unless you're a farmer. But then these markets created these new kind of derivatives, particularly the Chicago Mercantile Exchange, which created in 1972 the first futures on currencies. And they created it in part because the head, the chief executive officer, knew a guy named Milton Friedman. And Milton Friedman had at one time tried to sell, he thought the British pound was going to go down. And so he tried to sell it short. He was told he couldn't because he wasn't an institution. There was a small interbank market that would allow banks to do that, but it wouldn't allow an individual like Milton Friedman, even a prominent economist like Milton Friedman, to do that. Well, Milton Friedman got pissed off. So he talked to people at the Mercantile Exchange, and the timing, of course, was fortuitous, because if Nixon hadn't done that action, it would have been sort of, oh, well, I can't do it, I'll go away and do something else. But they came up with the idea, let's make it possible for anybody to trade currencies. And so Merck created that. And the thing, of course, is, you can say, well, that's not bad. I mean, there's $66 trillion in global trade. You get to hedge that $66 trillion, that's great. The thing is, once you create these markets, it doesn't stop people hedging. That's actually the smallest portion of these markets and these derivatives, because some people want to speculate. Some firms exist solely to trade on these markets, not because they have any interest in moving goods or services back and forth. They solely trade on it. We'll talk about one of them very briefly a little bit later. So the Bank for International Settlements, this thing called BIS, it does a survey about every 3 years, and they said in 1922, the average turnover in these currency markets was about $7 trillion a day. That's trillion with a T, $7 trillion a day. That's a lot, that's a lot. And the dollar is dominant in that turnover. Again, because the dollar is the world currency, the dollar is the most liquid of those markets. So to give an example, I'll repeat another way later. If you were in Norway exporting something to Mexico, you deal with the krona and the peso. You don't. You deal in dollars. You don't bother to try to translate from one of those currencies. You go through the dollar. And that's fine, because the next time you trade, you're probably going to need those dollars anyway. So whatever Norway is exporting to Mexico, or vice versa, is going to be invoiced in dollars. And that's because the dollar market is very liquid. And if you have to go from one currency to another, you go through the dollar. You don't try to go from the renminbi to the yen, for example. You go through the dollar. So the dollar is dominant as a medium of exchange. Okay, so let's talk a little bit more about, well, this is a nice picture. We talked about, just sort of break a bit. We've been talking about markets and currency. Here they are, all the different kinds of currencies traded around the world, back and forth, 100, 1,000 times a day. Including the currency market, by the way, is a 24/7 market. It doesn't stop at 5 o'clock in the afternoon. It doesn't start at 9 o'clock in the morning. It goes all day, all night long. You can do those trades in the dollar anytime. If the spirit moves you at 2:30 this morning, you can get up and get on the phone to your broker and say, I want to do this thing in dollars, okay? And assuming you have an account, you can do it. But international finance is also part of international trade. Because I said, after Nixon made that move, between 1970 and today, global trade increased twice as fast as global gross domestic product. Now, we're much richer overall. Yes, gross domestic product globally grew, but global trade grew twice as fast. Now, the study of global trade is a study in physical logistics. As I mentioned, I think I have an article in one of the magazines called Getting Stuff from Here to There. That's a physical logistic issue. But finance is equally important, and that's a study in financial logistics, getting money and the right kind of money from here to there. And without that ability, global trade wouldn't happen. You have to really get money from the buyer to the seller. So basically, financial logistics is about how the buyer gets money to the seller, the buyer gets the good, and the seller gets paid. So the question is, how is the value of something, and you probably know the answer already, how is the value of something traded between countries in two different currencies determined? How can we be sure that things get paid? Here, I'll take a simple example. Japan is the third largest producer of cars in the world. They're the second largest exporter. Toyota is the largest car producer in the world. Australia is the second largest market for Japan. By the way, I have one number error here. Maybe there's others you won't catch, but I have one I caught myself this afternoon. Anyway, but Toyota, building cars in Japan, pays their workers in yen, buys their supplies in yen, gives their executive bonuses in yen. Once the cars get to Australia, the Australian dealer is not selling them in yen. Australian dealer is charging its customers in Australian dollars. So we have this problem. Because Australia is Japan's second best buyer. By the way, this is where the error is. Japan's car exports are 118 billion, and Australia takes 23 billion of those. So if you've got this, you can correct them. So how did they manage to make this yen Australian dollar exchange work? And SWIFT is the answer. I said a Society for Worldwide Interbank Financial Telecommunications. SWIFT does not move money. Keep that. The SWIFT does not move money. They make the movement of money possible. And despite their acronym of SWIFT, it sometimes takes a couple of days. It's not SWIFT in like on the internet, you press a button and something comes up. It's not SWIFT in that same sense. It began sort of modestly in 1973, 239 banks in 15 countries. Today there are 11,000 banks in over 200 countries. It's very difficult, as the Russians have found out, to do significant global trade if you don't go through SWIFT. You can manage it by working around it, and the Russians have done to some extent that with selling their petroleum to China and India, but at a discount because China and India say, you can't go through SWIFT, where else have you got? If we don't buy it, where are you going to sell it to? So it hurts. But SWIFT is that core mechanism in the financial side of the world that's made the physical side of the trade happen. And it can handle almost all major currencies, but most of the transactions have the dollar on at least one side of it, sometimes both sides. The dollar is about 80%, euro is about 37%. By the way, there's the 200% because there's a buyer and a seller in each case. So what really happens is the bank of the buyer's bank, uses their SWIFT code to contact the seller's bank and says, we want to send you X amount of money, usually in dollars. And the seller's bank says, yes, we authorize that, and we'll take it. And so the banks, it's not the automobile company, Toyota, and the Australian auto dealer that does this, it's the banks. And they do that transaction. The yen is there. I haven't mentioned the renminbi, the Chinese currency, because it's only 7%, which is interesting. We have a country whose GDP is about 20% of the globe, but there are only 7% of the transactions through SWIFT. Now that has been growing. It's been growing. And 15 years ago, they really weren't even counted in terms of the amount that was done by renminbi, so that has changed over time, and it's continuing to change. So now that's the sort of the international piece of it. Let's talk about the US piece. Because the development of the international financial system and the changes that happen in our financial system really interlink in a whole lot of ways. And I think the best way to describe what happened in the US is the term financialization. Now, you've probably read, as I have, or some of you have read, long articles about financialization. The simplest way to think about it is that finance becomes more important institutionally and culturally. Not just talk about institutional changes, I'll start there, but it changes the way in which we live. And when one sector of the economy, like finance, becomes more important, it can mean another sector becomes less important. Manufacturing is less important today than it was at the beginning of the international financial system, when Nixon took his action. And financial deregulation was the key to this. How many have ever heard of the 363 model of banking? Okay. My son-in-law, his family had a bank, and he said that's why they used to operate. Borrow at 3, lend at 6 on the golf course at 3. But what he meant is that you put your money in the bank, and they pay you 3% interest. If you went to the bank because you wanted to buy a house, or set up a business, they have a loan, maybe 6% charge of the loan, and it's all done by 3 o'clock in the afternoon. The banker goes to the golf course. And it's a perfect, it captures perfectly a different world. A world that existed for probably almost a quarter century after World War II. You would be well thought of in the community. You wouldn't be obscenely rich, but you would be well off. And you would have a comfortable lifestyle. So we jokingly called it, when I worked in finance, the 363 model of banking. Now it's exciting. There are hedge funds, the private equity funds. There are funds, as I said, that do nothing but trade. Hedge funds have about $3 trillion in assets, almost all of it in dollar-denominated assets. And so they have two things that have happened. One, it's meant that finance, or actually finance, insurance, and real estate, finance sector has got an increased share of profits. You may have seen graphs like this in the past. So this starts really almost at the beginning of the international financial system, goes up to the present day. And yeah, there's this big run up there. What's that? Well, that's the housing crisis, right? They were doing fantastic. And how many of you have seen the movie The Big Short? Yeah. Go see it again. And if you haven't seen it, see it. I worked in finance. They got almost everything right in that movie. It's a perfect picture of what happened in that situation. It is amazing. I mean, there's a few things that they did to exaggerate, but in terms of the underlying dynamics, they really captured everything that was going on. So banks, the financial sector took a hit, but they've recovered. They're okay. We don't shed any tears for them. And making a decision to go into finance was a good occupational decision. This little graph says, what is the average wage and salary of everybody employed in finance, insurance, and real estate? It's hard to separate finance out separately on this, compared to the average wage and salary of everybody employed in the private sector overall. And you see they begin to diverge significantly. The green is the fire wage, the red is the average. I probably should reverse that. Fire wage should be red, shouldn't it? But anyway, green is the wage for people who went into finance, insurance, and real estate. Red for those who stayed in the private sector. And people did very well with this particular decision. My son-in-law gave me this slide. It is the new financial super mall, when you can do everything, anything. And the banker they can sell you futures, they can handle your will, they can do it between your estate, they can let you be a brokerage, they can do anything. That's the new bank, the end of the 363 model. I'm going to give you a minute to read this because I don't want to, so that you can just focus on it. So this is Emma Rothschild, actually of the Rothschild family, as a matter of fact, writing about a change in the way in which we live. And she's captured what happened in one paragraph here in a three-decade period, a shift from buying money spent on cars to money spent on brokerage services and bank services. And she's taken that three-decade period from a review of a book that was describing this. She's a really nice writer. Because we have a culture of financialization, not just an institutional structure of financialization, but a culture of financialization as well. And I'm going to talk about that under three headings: credit, debt, and risk. Now, my background, my parents were married during the Great Depression. So my sister and I grew up in a household in which debt was something to be avoided. Be very careful, don't take too much risk. Don't buy in credit. If you have to borrow to buy it, you don't need it. You can wait until you do it. So, but that changed. How many of you can remember when you got your first credit card? Oh, good. When was it?
2 years ago.
2 years ago. Somebody else who could remember. Who else could remember?
64.
What?
64.
64. I wonder how you did that, because women could not buy a credit card, could not get a credit card without a male co-signer until 1972. But in our liberalized side, we said, okay, it's probably okay if women go out and get a credit card, after all. You know. In 1970, only 16% of households had a general purpose credit card, one you could take to the grocery store, to the clothing store, to wherever. Today, today, much larger, sorry, hold on. About 80% of all households do, and more would have it, I think, if they could get it. And if you look at credit card debt, it's highest among middle-income families, but its ratio to income is highest among low-income families. And this is very expensive debt.
Yeah.
It ranges from about 22 to 28%. That's very expensive debt. So and credit card companies love it. And not only do 80% of households have credit cards, the average household has 4 credit cards. The average means some people have a lot more. I'm not asking how many credit cards any of you have, but you can put yourself right there. So this different, and I'm going to forward and then back. Here is the growth of credit card debt, starting from almost zero in 1970, taking a big dip during the Great Financial Crisis, and being sort of a little bit below during COVID. Those are the dips. These things are like recessions, great financial crisis, COVID, but coming back, let's return. Houses then are another major source of credit and debt in our society because home ownership is for most of the population in this country, the primary means of building wealth, the primary means of passing on to the next generation. That's true for somewhere over 75 to 90% of households in this country. And the interesting thing, by the way, because I know housing has been is a very intense, controversial issue, the rate of home ownership has not changed very much over the last several decades. I'll show you that right now. Here's the rate of home ownership. Now, it looks like a big change, but look at the bottom number and the top number. The bottom number is 63% of households owning their homes. The top number is 69%. Yeah, that's several million households difference, I grant you that. But still, if you average it out and say about 65%, about 2/3 of all households own their own homes, or jointly with the bank own their own homes, that's about where it is. And the other interesting thing is over time, most renters end up buying houses. If you survey renters, most say they want to buy a house. Not all, most say that. Now, one thing that has happened is the average age of purchasing the first house has gone up. It's gone up from in the late 20s to the mid 30s. So that is definitely getting more difficult, but it hasn't reversed people's desire to buy a house and have it. And so that's the second thing. Now, the growth of mortgage debt, well, which is right here, this is mortgage debt, also dipped a bit in the great financial crisis, but it recovered. So we've had this change in our outlook on credit and debt. The one that fascinates me even more in some respects is risk. The Federal Reserve does lots of things besides interfering in our currency market. Creates this nice series of money spent in gaming, as they like to call it. I call it betting, but gaming. And notice this is in billions of dollars, not millions, billions of dollars. I'll come back, I'll give you a chance to look at it in just a minute. The first state lotteries occurred in the late 1960s. I can remember when there was not a state lottery. Now all except 3 states have a state lottery. 3 states are Nevada, Utah, and Alabama. Nevada, probably because of the casino lobby, rather have you do it in person, don't go online. Utah, I suspect, because I think Mormon culture still has some different perspectives on risk and debt than a lot of the rest of the country. I cannot explain Alabama. It's an outlier. Who knows why? The other thing is, it's really amazing, is the growth of online betting, particularly sports online betting. You can bet on whether the next play is going to be a pass or a run, whether the next pitch is going to be a strike or a ball. You can bet on anything instantly as it's going on. I'm not saying this is good, because I actually don't think it is, but you can do it. And of course, how many people saw the movie Dumb Money? Okay, what's it about?
Okay, there's a lot to it. But what I understand is like the streamer kind of out of nowhere said that he's going to invest in GameStop, which is kind of like a physical place where you get your games and stuff.
Roaring Kitty.
Yeah, Roaring Kitty, which is accounting. And people were like, maybe this would happen.
Yeah, why don't I throw some of my money there? Why don't I take that risk, right?
But people thought that was really dumb. It's like, why would you do that? Because the company's clearly not doing well. But just like all the data says otherwise. But you had all these higher companies that were I get confused on the stock market when it's like basically they're putting their stock in it failing, right? And falling down, something like that.
But some people made money, and it was the attitude towards risk. I got this money. Oh, this guy says, Roaring Kitty, let's just do it.
And so you had like, I don't know how many people, but tens of thousands.
Probably millions.
Probably millions
Yes.
investing in this, just average people that are just like this big stock, pumping.
Yeah.
And they ended up winning, and it cost big companies billions.
They did.
Which I love.
Yeah.
It's pretty cool. No, they made a movie on Netflix that came out like last year or something.
Yeah, it's called Dumb Money, which is sort of a sarcastic or ironic title. It's a very interesting movie. So along with The Big Short, you have this assignment to see The Big Short and Dumb Money. And both were watching. Yeah, I think even if you watched them once before, because now that you've heard me talk more, they'll mean more to you, maybe. Anyway, and then what about crypto? I mean, there's no there, okay? There is no there. Now, so I was raised in a household where frugality was a virtue. I'm not sure that's still, I'm not even going to ask for you if frugality is still a virtue or not. As I said, if you can't pay cash for it, don't buy it. Now, I've moved away from that, obviously, but we have changed a whole lot culturally. That's what financialization has meant for us culturally, not just the institutional change, not just the end of the 363 model, but culturally. So if we look at this picture of the international financial system, we've got those components, various kinds of banks and non-banks. We've got markets. We've got those global NGOs, and we've got huge markets in currency that are going on as we speak. And then the US financial system, we've got the structural changes, the end of 363 model of banking, which was maybe good or maybe bad, but it's gone. And also this big income gap between people in finance and elsewhere. You know, of the top 1%, about a quarter of those are people who work in finance. Now, finance is a sector that employs less than 7% of the population. So it's a good elevator to the top 1% if you want to. You may have to work very, very long hours and take risks, but it's there. And financial share of profits grew, and then we saw cultural changes in terms of credit, debt, and risk. Okay, so now let us talk very briefly about the great financial crisis and then go on to talk about Trump and what may or may not be happening. I'm going to briefly, because with the exception of a few people in this room, you all lived through it. I realize you three probably didn't, but I'll try to review it quickly. So in 2007 to 2009, it cost about 8.7 million jobs, more jobs than any time except for the Great Depression. The unemployment rate hit 10% in October of 2009, highest since the Great Depression. Gross domestic product dropped 4.3%, which is big, and it's not a lot, but it's the biggest drop since the 1930s. Almost 4 million people lost their homes. And here I'm going to, as a side note, I think the Obama administration botched that seriously. They did a terrible job of dealing with people who moved out of their home through foreclosures. And to some extent, we're still paying for that politically. Housing prices dropped 15%. And this wasn't just a US phenomenon. Remember, the dollar is all around the world. Dollar-denominated debt is all around the world. It wasn't just a US phenomenon. It was a worldwide phenomenon. And two things I think drove it, which we'll talk about very briefly. Financial derivatives, which were used to increase leverage. Now, how many of you know what leverage is? Okay, so let me take a quick example. You want to buy a house. You decide to buy a house that's the median house price in the US today, which is $420,000. You go to the bank says, okay, the mortgage loan, we'll loan you the money if you put down $42,000, 10%. $420,000 house, $42,000 down payment. You are leveraged 10 to 1. You're controlling $420,000 with 1/10 of that amount. So leverage isn't always bad. A lot of us will do it at one time or another during our life. But the two poster children for the great financial crisis, Bear Stearns and Lehman Brothers, were leveraged at 35 to 1 and 33 to 1. That's pretty high leverage. And in the year before the crash, the median, now median means half people put down less and half put down more. The median down payment house was 2%. If you put down 2%, what's your leverage ratio? 50 to 1. Now, if the house doubles next year, it's fantastic, right? But the price goes down, you are totally wiped out. And you'll see some of that stuff in The Big Short. And a lot of that leverage is possible because of financial derivatives. So this was certainly the most significant financial crisis since the Great Depression. It was a worldwide crisis, just like the Great Depression. It was mostly a worldwide crisis, mostly because China really wasn't. China was sort of out of the global system at that point, and Russia was in a separate system, but mostly worldwide. I'm going to quickly talk about this because I know we want to get into Trump. It wasn't out of the blue. It wasn't this and all of a sudden happened, and we had no idea that it might happen. There were others, but I'll just note two that were multi-country, almost worldwide crises that occurred before that. One was what's known as the Asian Tiger crisis, where the countries like South Korea, Thailand, Indonesia, Malaysia, they were growing very fast, and there was a lot of debt that private developers, that they had borrowed in dollars. They borrowed in dollars, but they were dealing in their own currency. One day, the Thai government decided the baht isn't worth what we thought it was worth. We have to devalue it. Now, all of a sudden, you owe a hell of a lot more in your own currency than you thought you did. And that spread to the other countries. They've recovered, but capital flew out of the country. Think of capital flying out of the country and flying out of the currency, because we'll come back to that when we talk about Trump. The other was something that's probably less familiar, but also very important. It was called long-term capital management, which is probably the most ironic title anybody ever gave a company in history, because it neither long-term nor management. They started with a ratio of 30 to 1 in early 1998, which was manageable. All they did was trade. They didn't own anything. They took positions on interest rates, and they were betting the key interest rates would move closer together. Now, it wasn't like they were going to move 5% apart to 1% apart. It's not going to move from 0.5% apart to 0.25% apart. So they had to take huge positions to make a lot of money. And by the end, things didn't go their way. By the end of 1998, they were leveraged 130 to 1. The Fed had to step in and liquidate them. In response to these two crises, this happened before the great financial crisis, central banks really increased their reserves significantly, sixfold. And all of this had a lasting impact on that long period of growth. I'm going to turn now to this part where the dip is, the great financial crisis. Notice that after that, what has happened to the trajectory of growth? Basically flat, right? Hasn't declined, so it's not as sharp a thing as Nixon's, but it hasn't declined. It's fluctuated around a bit. And the amount of cross-border financial transaction went up and came down. So we have here this great financial crisis. It was significant, global. It was not unique. Central banks wrapped themselves up. Leverage was part of it. So, finance, trade, and tariff tantrums. And I do think they're tariff tantrums. Okay, I'm not making this a joke. But to get to this, let's step back for just a minute. I've talked about this international financial system that most of us have lived in, either all or part of our lives, basically running from 1970 to most of the current day. There was an earlier international financial system, in parallel in many ways, from 1870 to World War I. There was a different currency. What currency was it? The pound. And what country was it? UK. It was a different financial system, but trade grew. The pound was accepted around the world. The British actually issued a bond called the Consul. It had no maturity and lasted forever. They've retired most, but you can actually still buy them if you want to. It lasted forever. It was reset periodically. That's the confidence that they and many people around the world had in their economy at that time. A never maturing bond. And during that first period, it's interesting to look at what happened differently in these two periods of international financial system. From 1870 to basically World War I, Great Depression, countries that had been more or less similar in terms of their growth rates and size grew apart. The US, UK, Germany, France, Japan accelerated the growth. China, India, Africa, Latin America basically stagnated. China actually went backwards. And so the things that we think of today as sometimes the first world, the third world, the center and the metropole, whatever, the north, the global south, whatever your term is, that's when that gap opened up. And that's sort of half a century period. Now in our international financial system, of course the rich countries have continued to grow, no doubt about it. But the countries that lagged in the first time have grown much faster. Now that's a little bit deceptive because a lot of that has to do with China and the Asian tigers. It's not been true of African countries mostly, and only unevenly in terms of Latin America. But nonetheless, there are a bunch of countries that have grown much faster than they did and closed a lot of that gap between the rich countries and the poor countries. China's still not as rich as us, but the gap is much, much less than it was. The other thing that happened is that inequality in this last period, this last 50 years, grew significantly. It grew both in what people call the global south, that's a term which I'm very skeptical of what I'll use, and it grew in the rich countries. So to take an example, the Gini index, which if you're not familiar with, it runs from 0 to 1. Gini index of 0 means everybody has the same amount of money. 1 means one person has all the money. So in China, to take an example from the poor countries that have grown very rapidly, the Gini index went from 0.3 to 0.48, which is a pretty significant move. In the US, it also went up, but we started higher, from about 0.4 to 0.39 to 0.45, we're up there. Another way of thinking about it in the US case is that at the beginning of this international financial system in 1970, the bottom 50% of households had twice the share of income as the top 1%. Today, the top 1% has about 1.5 times the share of income as the bottom 50%. That's a huge redistribution. Nobody seems to talk about it. except Bernie and AOC, but basically nobody's going to talk about it. And the US is sort of an extreme case, but things like this happen in the UK and Germany as well. And things like that have a political impact. So what happened is that the working and middle income countries globally, if you think of a global hierarchy of income, the gap between the middle and working people in the rich countries and bottom countries, the lower countries, condensed a bit. Now that probably wasn't very visible, but what was visible is a gap inside the rich countries grew tremendously. The number of billionaires. When I grew up, nobody even talked about being a billionaire. Now we have the billionaire class. And what has happened in the rich countries is this kind of loss of status, a sense of loss of status. It's not that people have necessarily gotten poor, because most of us do live better than we did in 1970. But there's a sense that we don't live as much better as we think we should, or as much better as other people did, or something, some loss of status. And there are two kinds of answers to this that people say. By the way, in the first period of time, the political movements were mostly socialist and later communist. In this period of time, there's two different kinds of movements that are captured in the names of two people, Bernie Sanders and Donald Trump. And if you say, what is the enemy? What is the problem? We have two different answers. Sanders' answer, we know, is the economic elites. Trump's answer is others, the others. And his tariffs are about the others. So, and by the way, Trump is very much a transactional person, but this tariff thing has been an obsession. In the 1990s, he took out a full-page ad in the New York Times, which wasn't cheap, arguing for the need for tariffs. Then he was attacking Japan and Saudi Arabia, which were his bête noire at the time. So he's been on this kick for quite a while. And so when he came into office, he said, well, we're going to put a tariff on our two best trading partners, because actually our trade deficit with Canada and Mexico is bigger than it is with China. I know I was talking about China, but it's bigger than it is, not as big as Mexico or Canada. Only the EU's trading deficit as a total, and a total surplus as a total is as big as them. So he said, I'll put a 25% tariff on them. Then somebody pointed out to him, well, except for energy imports from Canada, we actually want to trade surplus with Canada. We sell them more than they do us, and besides, their petroleum is very important for people buying gas in places like Indiana, Illinois, Wisconsin, Michigan, states you sort of care about. So, all right, we'll only do 10%. But it's this grievance-driven switching one time to another. But then he decided on Tariff Day, what he called Liberation Day, I'm going to put a tariff around the world. Now, he has a piece of cardboard up there with this probably like 6th grade equation to figure out what the tariffs would be. And he did include, by the way, the penguins of Heard Island are really unhappy about this tariff because they're being charged 10%, even though there are no people who live there and they don't export anything to us. My first protest sign I did the other day was, the penguins of Heard, H-E-A-R-D, say dump Trump. My daughter drew a bunch of penguins on the sign. So that was my sign. And he'd take the average tariff rate to well over 20%. Now, the markets were not happy about this. I don't think you missed this, you probably saw it. Stocks fell very far, 4%, but more significantly, is people not only sold stocks, usually you sell stocks, in our stocks you go to what is called the safe haven, safety, you buy US treasuries. That didn't happen. They sold US treasuries, they sold the dollar. So somebody once said, well, the Trump trade turns out to be sell America. The interesting thing about this is what happens when a poor country or middle-income country gets in trouble and international investors lose confidence in them. They flee everything, the currency, the debt, everything about that country. That's what happened to us. Because the dollar also sold off. So he postponed the tariffs for 90 days. Our tariffs are still at very high levels, and there was this very quick reversal in the market when he announced it. Was there insider trading? I'll let you think about that. I'll let you think about that. Tariffs jumped up, we know that. Okay, but let's talk about tariffs, because tariffs have gotten a bad rap, and some of that's well-deserved. But let's be clear, there are two questions about tariffs. Are they good or bad? And who pays them? Now, you can design a system of tariffs you might say are good. Suppose you have an industry in which you want to preserve, in which people in another country which pay lower wages are setting up things to compete with you. You could decide to protect your own labor force by putting a tariff on that imports from that country. You might think that's good or bad, but you could do that. You could say that we have a social goal for this tariff, and it's to protect this part of our labor force. Or country is manufacturing something the way they use is very polluting. You say, we don't want to pay for that pollution. We're going to tariff on it, and we will use that to combat climate. Now, this can go to extremes. Trump's Commerce Secretary, Ludnick, has said, we'll start making T-shirts and shoes back here. Okay, do you know what the average wage is of a Bengali textile worker? $113 a month. And we're not going to compete with that. And we shouldn't want to, actually. Should not be our goal. In Vietnam, they pay them $300 a month. So anyway, but just maybe there's things that you could do, or you say we really want to protect a cutting-edge technology, a particular kind of chip. Let's put a tariff on the competition. So you can imagine tariffs that sort of do well. They're not these across-the-board blanket tariffs that are just put on when somebody gets up in the morning and say, I'm really angry at this part of the world, I can put a tariff on them, which seems to be the basic rationale. Then the question is, who pays them? And there are several logical possibilities. Now, Trump believes, clearly, and Peter Navarro, the senior trade aide, believes also, I can't tell whether Scott Bessent, his Treasury Secretary, Ludnick, his Commerce Secretary, actually believe, but they say that the exporter pays the tariff. If China wants to send stuff to us, they'll pay the tariff to get it here. There's not much evidence of that in the real world. And in fact, if you look at what happened to the tariffs Trump put on China the first time around, it turned out, all analysis showed that U.S. business and customers paid it. Another thing may be the importer pays for it, which is probably mostly the case. And at times, maybe there's a split. Maybe the exporter and importer, each say part of half. And there's another answer that people don't think about. Trade just may go away. After the Smoot-Hawley tariff in 1930, our exports and imports dropped by 2/3. Trade just went away. That's all that happens. Trade just went away. The world deglobalized. It seriously deglobalized in the 1930s, fragmented. It went away because of those tariffs. But looking at the tariff rationales advanced by the current administration, the first rationale is, well, if we put a tariff on people who are exporting manufactured goods to us, because Trump's approach is, Trump imagines us, we're back in the 1970s when people were working in steel mills and coal mines. He said the other day, the coal miners love to dig coal, they want to go back and do it. I've been in a coal mine. I think so. Not if you can avoid it. I mean, I have met coal miners retired who regret the fact that their miners are gone, but I don't think they'll go back and work there. But putting a tariff to bring industry back, there are some complicating factors. It takes a while to build a factory. It doesn't spring up overnight. But it's not just the factory, it's the suppliers too. You also have to have a new supply chain. If you're going to tariff everything that comes in, then the supply chain has to move inside also. And maybe there's some things we can't make here. We put a tariff on coffee. We are never going to grow coffee to the extent that Americans drink it in this country. We just can't do it. That's reality. Now, there's some things we could expand production on. The U.S. auto industry has unused capacity of about 3 million cars. So you could expand auto production. Maybe a question where you would sell the cars, but you can actually, over time, you can't probably ramp them up overnight, but in a 6-month period, you could probably increase auto production by some number of millions. The second rationale here is it will reduce the fiscal deficit. So Scott Bessent, Trump's Treasury Secretary, has this 3-3-3 model, not 3-6-3, 3-3-3. He says he wants the real gross domestic product to grow 3% a year. Trump managed that only once in his first term. He wants petroleum production to increase by 3 million barrels a day. That actually we probably could do, although not at current price levels. Current price levels, fracking, which is where we've really ramped up petroleum production over the last 2 decades, you have to be above the $60 to $71 a barrel area, and we're not there. They're not going to drill no new wells at $60 a barrel. They're not going to do that. He also wants to have our deficit no more than 3% of the total economy. There's a third rationale that Trump has played with and talked about in inauguration, when he said, we're going to create a Department of External Revenue. This will replace the Internal Revenue Service. We'll raise so much money that we will cut, maybe eliminate, at least cut your income taxes. This is sort of the hook to a lot of this base. Your income taxes will go down. We'll bring all this money in. Now, there are some problems with that. One, Peter Navarro believes that we could bring in $6 trillion over 10 years. Now, that's a lot of money, I grant you that, but that's only $600 billion a year. The federal government's budget is $6 trillion a year. Goldman Sachs says we could maybe bring in $300 billion a year over 10 years. The Yale Budget Lab says, yes, you could, and it'll cost the average American family about $4,000 a year. So there are some complications here, okay? Let's do a little bit of tariff math before we wrap up. So our value of our imports last year were about 3.3 trillion. And part of that was the services. We run a surplus in services. We export more in services than we import. Our exports are only 1.9 trillion. So, but if we put tariffs on imports, they'll put tariffs on our exports. So this is this 6 trillion, 3 trillion, and 4,000. So here's another route that I don't know if you've heard about yet. Trump has talked, and his chief economic advisor, a guy named Stephen Moran, has talked about a Mar-a-Lago Accord. Now, this being Trump, it's because there was a thing called Plaza Accord. Trump is not a very original thinker, so he wants something on Accord that will be bigger, just like, as I read the other day, he wants to acquire Greenland because he'll then be the president that adds the largest amount of territory to the U.S. in history. That's what he'll remember him for. Actually might try to do. This idea would bring all the countries of the world together, or at least those who are willing to come together, and would agree to it's a complicated, because I don't think we can pull it off, to weaken the dollar a bit, but still to make it the dominant world currency, and also maybe to require people to hold our bonds forever and to pay a fee for holding bonds. Probably going to be a difficult sell, but there's some things that have changed since 1985. We did pull off something sort of like that in 1985, but in 1985, there was no China. There was no China. There was not another country out there was 20% of the GDP. There was not a euro. There were individual fragmented European countries. In 1985, we were 15% of global trade. Today, we're 10%. You know, it's remarkable that several people in Trump's administration seem to share his blindness to how things have actually changed during this international financial system I talked about. So I think there's some problems. The last thing I'll say is, why is it so chaotic? Why does it seem to be 1 hour to another? Which hasn't happened the last 2 or 3 days, I'll grant you, but why? And I think the answer is, Elizabeth Warren has said several times, personnel is policy. What she means is the way a policy is executed depends on who you put in those positions to do it. Who is in the position to execute tariff policy in this country? Donald Trump, right? So Donald Trump is not a consistent thinker. He's very petty in a lot of ways. And so what he feels from one day to another influences the tariffs a lot. But there's also other things going on. There are different groups within his administration or near his administration who have different end goals. So the Wall Street Journal, the Koch brothers, your friends here in this town, and the Peterson Institute of International Economics, who are not inside the administration, who are free traders, they don't like tariffs. And by the way, their answer is not a good answer, but their critique of the tariff policy is really good. So if you want to read somebody's simple critique of tariff policy, go to Peterson Institute for International Affairs or read the Wall Street Journal. They understand what's wrong. Their idea we go back to the free trade period when people lost out in terms of manufacturing jobs is not the answer, but they do understand it. There are CEOs from some companies who would like to have that protection. I'm running a steel company. India or China producing steel cheaper than I can. I really like that protection so I can expand my steel production. And we probably could expand steel production. For every new job you create in steel, you lose 3 jobs downstream. It's a difficult trade-off. And then there's sort of anti-China hawks, of which I would put Trump and Navarro among the things, just anti-China. So let me take a very big, very, very, very maybe picture. Maybe the outcome will be this fragmenting of the globe into just kind of trading blocks. You've got the EU, which is about 30% of global trade. You've got China, which is about 12 or 13%. You've got ourselves, which are 10%. Maybe, but the EU and Canada, I know people say, Canada's a long ways away from the EU. Wait a minute, we're just as close to EU and NATO as Canada is. Actually, they're closer because they extend a little bit further out there in the Atlantic Ocean. Then there'd be China and Southeast Asia, which is also a little problematic because a lot of those economies duplicate each other, so they're not natural trading partners. Then there's the US and, I don't know, Russia, who knows. Anyway, this is a very maybe long shot, but I'll leave you with this. A tariff. All right, and that's a lot to cover, but I think we have time to talk, ask questions or whatever, anything you want to
Some questions, or take some questions?
Oh, just comments. They're telling me I'm just crazy and wrong.
Go ahead.
Well,
First, a small anecdote. You mentioned that 80% of households have credit cards. I think that's much smaller fraction in Germany. And I got my first credit card when I came to the US in '96. I had stepped off the plane, gotten to campus, Virginia Tech. The first day I walked past the student center, and I think I'm signing up for different student organizations. There was the Society of Physics Students and the Juggling Club, and there's other booths, and I give them my name and my address, and I forgot what I thought they were, but next week I got a credit card in the mail.
Good, good. Well, good. You probably use it.
I did use it. It came in handy. So many places don't even accept cash. But my question, tariffs impact the flow of actual goods across borders. But much of the financial transactions, as you've mentioned, there are many companies that don't even trade in goods, they just trade in financial products. So a lot more of the SWIFT transactions actually reflect no transfer of goods. There's every once in a while you hear about Tobin tax. What's your opinion on that? Can you maybe briefly explain it for anybody who doesn't know it?
So James Tobin basically had the idea that let's throw some sand in the gears. Let's slow down this process of financial transactions. And now we talk about it in terms of financial transaction tax. I've done a lot of work on financial transaction tax. I've appeared before the Illinois state legislature arguing for one. I have never won those arguments. I think it's a good idea, but I don't know if we're going to get it. And it's interesting you raise about what these trading companies do. I'm trying to think of Ken Griffin, who's the head of Citadel Trading, which is a huge financial trading company. I think he has said he doesn't particularly like tariffs, but he's not going to push on that. I think partly they are, like a lot of people, sitting there and waiting to see, let's see how this is going to play out. Let's see what's actually going to happen. But I'm sure during the April crash, they were there and they were selling. And then they bought when they thought it came out. Sure. Or is it somebody over here? Okay. Yes, right. Sorry, I know it's right in front of me. Yes.
Public citizen and Ralph Nader's group. He terms the Trump's policy on benefiting his own family.
There's that.
Which he terms crypto-fascism. Mm-hmm. How relevant and how accurate is that term?
Well, definitely Trump is concerned about...
Just stop the sharing off.
Okay. Stop that off.
Keep going.
Okay.
Keep going.
So definitely Trump is very transactional, and he does care about money and power. I would more describe it under Mama, Make America Mercantilist again. Because mercantilists believe that balanced trade is the goal of all countries and all economies. And Stephen Moran, his chief economic advisor, seems to think that's a goal also. Part that sometimes gets in the way, or Trump's own personal demand to have more and more, often gets in the way of a coherent policy. That was one of my last points. It's very difficult to say this is Trump's tariff policy, or as Brad Nong wrote the other day, it is incorrect to say the U.S. has a tariff policy. We don't have a tariff policy. We have a tariff chaos, and that's the only way to describe it. Yeah. Yes.
Well, I was just going to ask about this difference of goods versus services, and how apparently the U.S. has an edge in the whole world on services,
Yes.
including not only financial services, but things like anything digital.
Professional services,
training.
yeah, right.
And so what kind of percentage is that of the services of these?
It's not enough by a long shot to overcome the deficit, but it's interesting Trump completely ignores that. We also, by the way, have a surplus in agricultural exports. We export more agricultural goods than we import. Trump has not mentioned a tariff on services, and I don't think China's response actually talked about services either. It's like services is just over there somewhere, and we're not paying much attention to it. There was a while in the 1990s when the globalists would argue that we will do so well in services that we will overcome our deficit in goods. That didn't happen, but that was one of the arguments advanced for a while about why free trade, World Trade Organization is a good thing to be part of. Jennifer?
Yeah, my late husband was a financial advisor. I worked for him, and so that was during that peak that you've seen up there, and that was exactly what I was gonna bring up, was how, they said that we were going to trade, they were gonna give us goods, and that was gonna be good for them because, you know, their economies are so poor, and that we were gonna give them something. And I said, well, what are we gonna do for jobs? And they said, oh, we'll do services. People will have their nails done, they'll have their hair done, they'll go out to restaurants, and that doesn't translate right. Everybody in that office, you know, because I just have a bachelor's and they have a master's degree.
They must be right.
I didn't know what I was talking about.
The question of manufacturing, which is part of what your point is, it's an interesting one. We're not going to get textile manufacturing back, and we shouldn't try. But there's some kind of manufacturing, high-tech goods, green technology, except we can't get anywhere with that in this administration. Those are things worth investing seriously in. And I don't know if I don't think I don't have, I'm sorry, I don't have the appendix here, but I'll hold it up to tell you that, maybe you can see this. This is the growth of construction and manufacturing in the last few, and the inflection point is the CHIPS plan that came into place. So manufacturing and construction growth, which has basically been flat, was about to take off. Trump, however, doesn't like it, and I'm afraid he's going to lose some of that. That's why I said tariffs are not always bad, but tariffs in the way that, you know, it's, I mean, these are, in a sense, these aren't even an economic policy. These are personal petulance in a whole lot of ways. A whole lot of ways. Yes.
I've been reading more on this. I don't know.
Say a little louder.
But how much do you think the motivation behind Trump, especially Elon Musk, like this rising techno-fascism, like these circles, like heavily tied to it? I mean, the push for, you have those like elite white supremacist circles that also want to go over to Mexico and Greenland and Canada, which is why it's like this random motivation that Trump has had that he's never even talked about, you know, in the last few years. That's such an obsession.
Yeah,
I can only think of that being connected to those type of techno elites that want that tech state of America, they call it.
That's interesting because it does connect with, you know, Peter Thiel was J.D. Vance's mentor. Peter Thiel believes democracy and capitalism don't go together. I mean, he's out front. I would describe Trump as a revanchist. Revanchists are people who want to go back. And by the way, an important part of that, and this the Nazis did, is to erase the history of the immediate past. Why do you think he wants to take over the Smithsonian Institution? Why do you think he wants to take down statues? Why do you think he wants to take DEI out of schools? It isn't just that he wants to stop it, he wants to erase that, as the Nazis, for example, wanted to erase the Weimar Republic and go and just start over again. And yeah, I could call that fascism, yeah. But I think revanchinism has a sort of a longer theoretical tradition behind it. It's worth reading some of the people who write in that vein, what they're thinking and their rationale for it. Because Thiel didn't come to it right away. He has some essays on how he came to those conclusions.
But I know techno-fascism is so obsessed with bringing manufacturing here as well.
Yeah,
It's a huge thing. So it's just like I see a whole lot of it.
When I was a graduate student many years ago, when the dinosaurs were still running around the world, I was on a study where we talked to automobile assembly line workers, because I was in East Lansing, I was in Michigan State, and there was an Oldsmobile assembly line in Lansing. And so we interviewed them, and I always remember what woman said to me at the end of her shift. She said, everybody should work on an assembly line, but nobody should have to work on an assembly line. It was the most profound insight I think I ever got to that kind of thinking, of that manufacturing. Yeah.
I think you made a connection between tariff-protected steel industry jobs and loss of jobs downstream. Could you clarify that a little bit? Were you talking about loss of American jobs downstream?
Well, the steel products will become more expensive,
Okay.
which means certain things won't be produced, which means certain people won't be hired.
And the ratio is 1 to 3?
The studies I've seen are 1 to 3, but I think it's going to vary from industry to industry. And there may be, we may decide, we certainly may decide that it's important to have the capability of producing, let's say, masks and other things you need to do in the pandemic, even if we have to pay people whose job extra for that, even if we have to put a tariff on that and import support them. I think there are some things worth pursuing. That's why I try to say tariffs are not necessarily bad, but they have to be designed and thought through carefully.
The other thing I wanted to respond to that comment that you heard from the woman about working on the assembly line. And I can appreciate that. I worked here for a short while in a manufacturing assembly, and I would be a communist if I had to deal with it.
She wasn't, but she might have been, I don't know.
But the problem is that she probably had a living wage, she had benefits.
Yeah, she did. No, she did, definitely. She was in the UAW.
Now, when somebody graduates from high school, the chance of them getting a job where they can afford living is pretty tough. Pretty tough. You either have to go to trade school or you have to go to college, one or the other, or you go to the military.
Yeah.
So, I think that reflects on the, the rich getting richer and the poor getting poorer. So I don't know how you want to resolve.
That's a good point. Let me pick it up this way. People talk about manufacturing jobs as if they're high-paying good jobs. They're confusing correlation with causation. With correlation, because those are the jobs that organized into unions in the 30s and in the 40s, and therefore we've assumed that manufacturing jobs are high-paying jobs. A McDonald's worker in Denmark makes more money than an auto assembly line worker in Alabama. Why? They're unionized in Denmark, they're not unionized in Alabama. Collective organization, collective agreements shifts the balance of who gets how much money in a political economy. It's as simple as that. Yeah.
Don't forget that Elon Musk and Trump sat there and laughed about how they don't like unions and they like low wages.
They do, for sure.
And they came out in the open and said that.
Yeah, Musk is part of, as is Amazon, going to try to get the courts to rule that our National Labor Relations Act and board are unconstitutional. And this is going to be interesting before this Supreme Court. I think I'm going to be cautiously optimistic that I think some people in the Supreme Court have thought, maybe this is going too far. maybe. One thing that worries me about, I think Trump is in a bind globally in these tariffs, which I think is good in a way, but it also means I think he's going to be more dangerous domestically. He's a guy who gets frustrated. And what happens to bullies when they get frustrated? They lash out in other ways. I mean, let's try not to end this in bad news, because somebody said something good. I mean, I do think that his bluff has been called globally. And I mean, they talk every day about countries lining up for deals. We can't say anything. We know what's happening. Countries lining up for deals. Oh, you saw in the paper the other day, China said there's no talks going on.
Right.
And when somebody is saying, I want them to call me, he's saying, I want Xi to call me. You're just saying you're not the dominant partner in this game.
If the phone doesn't ring, it's me.
Right.
You think Trump's going to raise tariffs, keep tariffs high on Mexico? What do you think?
Mexico's an interesting case. I mean, Claudia Sheinbaum is a good negotiator. I'm afraid she may give too much at times, but she's taking a different tack than Mark Carney in England and Canada. I mean, Mark Carney was in the British financial system during the Great Financial Crisis. He's not going to take guff from anybody. She's a different kind of person, different kind of leader. She's done well so far. We'll see what happens.
Except they don't assassinate her.
Yeah. Well, we hope they don't assassinate Bernie or AOC also, because they're doing fantastic jobs. So they were doing really well. Yes.
I'd like to go back to the 2008 financial crisis. You said
You want to go back and relive it?
it's not quite the same way, but you said Obama botched it. How did he botch it, and how could he have done better?
During the Great Depression, FDR created the Homeowners Loan Corporation. What Holt did is buy up houses that were going to be foreclosed, keep the homeowners in there, and reset the terms of the mortgage. That's what we need to do in Great Financial Crisis. We didn't come close to doing that. I went to some of those hearings where people were being in front of judges, where people had to appear because they were being foreclosed against. Most of them didn't have any lawyers. They couldn't afford a lawyer, and sometimes they couldn't even show up because they didn't know about it. So it was really handled poorly at the federal level. And remember, we're talking about people being thrown out of the single largest asset most of them will ever have in their own life, and something that maybe they hope to pass on to generations. That grievance doesn't go away quickly. That sense of being unjustly treated doesn't go away quickly.
And the banks got off.
Yes, as we said, you know the slogan, go out there.
I did know my niece, they did save their house through that particular program. But, yeah, those balloon interests are balloon mortgages, is what really.
Well, the market is, I mean, there's tons of studies, the market of subprime mortgages said that people who would have qualified for prime mortgages were either single women, people of color, got subprime mortgages with higher rates and quicker resets. And I just said nobody went to jail. Nobody went to jail. Except in Iceland. Iceland put the bankers in jail.
I just wanted to ask you one thing. I've talked to you about the private equity organizations, how they take over organizations. It's one of the more interesting issues. So why don't you explain that?
So, I know this is going to sound crazy. I explained it to a doctor friend of mine a couple of times, and he finally says, okay, how can this happen? And I accept that it's true. So let's say Jennifer and Ken, they have this nice company going, but Holger and I decide, we could really make it better, and we can make a lot of money by doing it. So let's go borrow some money from Jim's bank. We'll buy up the stock. We'll put up 10% of the purchase price in ours, 90% from the loan. We'll then acquire the company. The first thing we'll do probably is declare a special dividend, because we are now the owners. Declare a special dividend to us, which will more than pay back what we owe Jim, and then we'll decide how to run the company. Now, we don't want to deliberately run into the ground. We didn't buy it to run into the ground, but we're willing to take that risk as long as we get paid up front. And then we'll see if we can make, well, we don't need you, Ken. We can just, let's keep Jennifer on, but we don't need you also. And let's not make this product. Let's just specialize here. Or maybe we won't have any physical reality anymore. Maybe it'll be like J. Crew, where we just have the brand. You don't need to have you don't have the physical footprint. We got lots of things we can do. And that's why, and so as this is what my doctor friend had trouble comprehending. You're using, and our pledge, our collateral for the loan, what is it? It's their company. And my doctor friend just, it can't be right. I said, Steve, I've done it again and again. It may not be right, but it is what happens. It's that simple, really. And it's because it's leveraged. Remember, let's explore this. So let's say we had to buy up their company for $100 million. And we got $90 million loan from Jim, $10 million of our own, and we play around with it for a while. We spend a special dividend. We've now really covered our costs. And then 2 years from now, we sell it for $120 million. What's our rate of profit? It's not 20 on 100, it's 20 on 10. Yeah. We only put up 10 million of our money, okay? We had to pay him interest, so we take a little bit of it. But it's not 20 on the 100 million, it's 20 on the 10 million. It's leverage. That's what private equity is big and very good at. Yeah. Huh? I remember when private equity was sort of a new thing. I was thinking, what is this anyway? Because I was working in finance at the time. Holger, we're rich now, right?
But not proud of ourselves.
What?
But not proud of ourselves. Yeah, please kind of. Yeah, strange word.
Only for, do we have any
It's
questions for any Zoom participants?
oh, okay.
I don't know.
Do they have questions?
Check on
I don't see any in the chat. We have just a few people on Zoom.
Okay, that's fine.
Any questions from any of you?
Maybe they have trouble hearing it, I don't know.
Okay.
A question?
I don't see anything in the chat. Somebody unmuted themselves, but I don't know if we can hear them or not. We may have to.
Try it.
No, I think nobody's talking. Okay, no questions on that.
All right.
Oh, I do have one more question.
But the gentleman behind you hasn't asked a question yet.
Okay, one more thing.
Two more things. The topic of the discourse today. What do you think of Professor Jeffrey Sachs, the International Economist?
Well, when he was telling us that the Soviet Union could jump from communism to capitalism when 6 months, I didn't like him, but he's gotten a lot better than that. He really has. He really has. I think he learned.
You think he what?
I think he learned.
He's changed
He
somewhat.
changed, learned, yes.
Since shock therapy, he was.
Alzheimer from University of
Yeah,
Chicago.
yeah. No, he's got a lot better. I like what he does.
Yeah,
Yes.
he's changed considerably.
Do you sympathize with their views in Ukraine and Gaza?
I don't know their views in Ukraine and Gaza, I'm sorry to say.
Well, that leads maybe too far. Let's leave
I
that for
actually don't know their views.
after.
I don't know their views in Ukraine and Gaza.
Yeah.
I generally don't know them.
Basically,
Well,
they say
I just had a quick question. Why should we take all of our money out of the stock market and hide it under a pillow?
I'm not a stockbroker. I wouldn't at this point, because I think the market discipline has maybe stayed the course for some time. I don't know what it's going to, he's given himself 90 days, and the market's like, oh, let's go back and be markets, like we always were before. But it also is striking extent, I may have said this already, to which avarice and greed blinds you. People on Wall Street were very excited about Trump, very excited. And I'm sitting there thinking, what do you think he's actually going to do? Oh, he's not the terrorist. It's just this thing out there. It's just a negotiating lever. As I said, it's been an obsession for at least 3 decades. And when Trump says he's going to do something over and over again, this is what worries about Greenland, by the way. He says over and over again he's going to do something. He usually does try to do it.
Whether it happens or not.
Yeah. But I wouldn't. I still have money in the stock market. I would have some money in things like treasuries also. I would definitely have some money in treasuries. And if you don't, you can open a Fed account and buy treasury bills for no commission at all. It's really pretty simple. You have to connect it to your bank account because the money just go back and forth between the Fed account and your bank account. But I don't know why more people don't do it. Why pay a broker to buy a treasury security when you buy it for free? And you do it online. And you don't have to think about it. You don't have to worry about whether it's going to be gone tomorrow because it's at the Fed. It will be there.
All right, thank you very much. That was a very interesting, comprehensive presentation.
It was a pleasure to do it. It was a pleasure to do it. I've only done it for my daughter and husband once, so this is the first real time.
All right. Yeah, clearly with all the questions, there was a lot of interest. So thanks again.